Our next speaker, she's someone that I've really come to respect in this space. She's someone I know quite well, actually. When I first started investing in passive real estate investments, she was someone I looked to provide a lot of direction in that area as well. This is Adipia Dorico. She's an investor, entrepreneur, and advisor. She's a principal and the VP of strategy at Alpha Investing, a private equity real estate firm. You guys all saw her at the panel, but she's also the co-founder of this amazing organization called Women of Wealth, an organization empowering women to take wealth firmly into their own hands. She's both an active and passive investor, and she's passionate about helping more people create a healthy and sustainable financial foundation. I'm really excited to hear her speak. Adipia, welcome.
Thank you. Thank you so much. Great. All right, hi again. Hi, everyone. I will start by saying that this is the first time that I have spoken on stage since February of 2020 at the Best Ever Conference. So it has been a while, and it's pretty awesome to be back. So I'm going to be talking about diversifying within passive income, and this is a lot of my story, my journey, and the lessons that I have learned. So a little background on me to kind of give the context. So I started in traditional finance. I started working in a bank when I was 18. At a really young age, I already understood that if I could make enough of my own money, nobody could tell me what to do. So that was my whole plan. Even my husband today calls me Little Miss Independent because I just have to have my, things my way, but really this idea, and it leads into this movement of financial independence and freedom and empowerment. But I started working in a bank when I was 18, so I learned about mutual funds, I learned about stocks and bonds, I learned about dividends. Like, these are the things that we are taught in the certified financial planner and financial advisory. This is the Wall Street movement. And I worked in banks, I worked in hedge funds. I was at a hedge fund in 2008 when Lehman went down, so I very much experienced and was participating in a fund that almost went under. Morgan Stanley was our trustee. So a lot of experience with that side of things. And I made a big pivot in my life and in my career, and I went into entrepreneurship. And in my journey into entrepreneurship, I actually ended up in crowdfunding, of all things. And I was doing it with my sister. I built a global brand for her with her art, because I believe that artists should be able to make money and a living with their art. And so we pioneered this. And so that was so much fun. And so we did a lot of our own crowdfunding. And so when the Jobs Act came out in 2012, 2013, I thought, oh, how interesting, I can turn our fans into shareholders, which didn't actually happen until 2016, but regardless, that's what got me into real estate crowdfunding. So I'm one of the very, very early entrepreneurs of real estate crowdfunding. I helped launch the industry. I was the CMO at Patch of Land. So I started my real estate journey on the hard money lending side, on the residential hard money lending side. And so that's how I got into it. Now, I am, I think like many of you, pretty smart. I'm ambitious. I like to be in control. I don't know if that's familiar. And I like to figure things out. So as I was getting started with the startup, with crowdfunding, it was called Patch of Land. He wasn't my husband at the time, but we bought a home in Inglewood, California. And I don't know if this is moving here, let me see. So we were like, let's renovate our home. Right? Let's do a little renovation. So we did really well. So we bought it before the stadium. So I started inactive, but I started the way I think a lot of us start, is like, I want to understand it, so I'm going to do it myself. So this was our home. And when we sold it in 2012 after 5 years, we didn't renovate it. We ended up tearing it down to the studs and building it right back up. We were 2.5 times over budget. We did convert the garage to an ADU, and I will say that the pandemic gave us an exit that I did not think we would have for another 10 years. I did not think that we would ever get our money back out. And my husband and I got married, so we didn't break up. We didn't do the whole divorce thing, doing a renovation. We actually ended up getting married. But the lesson, so we spent the first 3 years building, rebuilding, active. So even though I was working in real estate, all of my money went into this home. Every single dollar went into this home. And so we did this, and then we figured out, though, in doing all of this, like, hey, like, this ADU needs to make us some money. So maybe we'll do some passive investing with the ADU. So we hosted our garage as on Airbnb. We started in 2018. We were an Airbnb Plus host by 2020. We were killing it, did really well. If you allow pets, you have a really great niche when you do this. So this, however, was not active, or was not passive. It was very, very active. And after all was said and done, we only broke even on what it cost us. And this is one of the things when we get into things like, I'm gonna do this myself, I'm gonna learn, it's easier to understand, it's more hands-on, but you have to really look at what the costs are and what your net profit is when it comes to anything. So when I started working at Alpha in 2018, I had moved at this point into the private equity side of things. So truly passive income when it comes to real estate. But again, it wasn't until 2020 that I actually really was able to exit and have some money to invest with. So I had some other attempts at passive income, because don't we all try to find other ways to do passive income? So I wrote a book. No passive income from the book. So you have to have like a whole business to actually make money writing a book. But regardless, it was a beautiful experience. I'm very proud of my book. And so I got out of town. So in 2020, after writing this book, after 5 years of really rebuilding this home, we went from Inglewood, we moved to Topanga. And that's when I started to properly invest in passive real estate specifically. So honestly, I was a little exhausted, and I realized active investment is just not for me. Even though Andrew, my husband, he really prefers active, or so he thinks, because he is very hands-on, very, very hands-on. Like, we actually rebuilt our home ourselves. And so also for the first time in a really long time, I had some money to actually work with to build a passive income portfolio. So again, having come from this like Wall Street, very traditional finance background, when I first started learning about real estate in the context of equity and private equity, it was shocking to me, because even if anyone's ever taken a series like 7 or 69 or anything, like there's like one page on real estate and it's about REITs. So coming from this finance background to learn about real estate it was a little bit shocking, but I started with private real estate syndication. So I started with what Alpha is doing, and we talked about it a little bit before on the panel. So it was multifamily, senior housing, and actually student housing at the time. So once I got started looking at all the different kinds of passive income opportunities, even in real estate, I was like, oh my God, there's so much. There's so much. Then there's triple net, and then there's retail, and then there's hotel, and then there's this, and then there's that, and then it just went crazy, and it can be really fun. It can be really fun, and I at least think it's really fun to invest in, to make investments. But it can also leave you a little bit perplexed about what exactly to do, because there's really so much out there. So there's all these investment opportunities. And so what it really comes down to is the strategic diversification. So you'll go through this process of there's all of these things that I want to invest in, and there's all of these returns, and there's all of these great operators, and everybody has a good story, and everybody has a great track record. But you really have to come back to yourself. Like, you really have to come back and have a plan, because there are amazing investment opportunities. And a gentleman earlier showed the Tiger 21 asset allocation report, and even the Yale endowment model that is referenced a lot. We know that real estate is a really big piece of passive income investing, or just investing in general, as well as private equity. But we have to come at it with a strategy. All right, so for me, the foundation, having come from this Wall Street background, having been in the hard money lending, so that's residential lending, that's like fix and flip lending. And even in the fintech space, because I was part of that space, so peer-to-peer lending, like there's so many opportunities to really make passive income. The foundation for me, and I believe to be the strongest foundation, is private commercial real estate. So some of you know the stats already, but in short, it does offer the best risk-adjusted returns. It historically outperforms the S&P, and I'm not just talking REITs, because REITs can outperform S&P, but if they're traded REITs, then they trade the same way. So currently, anything that is tradable on Wall Street is going through a very rough time. That doesn't happen with private commercial real estate, because luckily, we're saved from ourselves. We can't just sell it when we're freaking out, like we can sell a REIT or anything else. So private commercial real estate, it does generate consistent cash flows. They might not always be double-digit cash flows, right? But they're consistent. It's an inflationary hedge, and one of the best things really about it is that with private commercial real estate, it does allow for a certain kind of diversification across different markets and asset types and different strategies. Jim just went over a lot of the preferential tax treatments that one can have with real estate. So for me, real estate forms the foundation of my passive income portfolio. All right, so this is really where it all kind of lands. So when you're building out a passive income portfolio, because the diversification, everything starts with self-knowledge. So knowing your financial goals and your life goals, all of this is really important to being able to choose and discern and say yes, and more often say no to opportunities because they don't fit what institutional investors call a strike zone. But what are your goals, and what are your passive income goals? In my group, in Women of Wealth, we talk about passive income goals, and some of the women, when they first come in, they don't even know passive income is an option. They say, what are you talking about, passive income goals? And so some of us will share our goals, like maybe it's like, I want $30,000 a month. Like someone's like, I want 100, and some of our women are like, oh my God, you can do that? I was like, yeah, we can do that. And so then we can start to really move up and really work on where we want to go in our lives. So knowing what that passive income goal is, what is it monthly? What does it represent for you? What does it do for you? What is that goal annually? And this allows us then, therefore, when we're building a portfolio, to really know what we're going for. What kind of investor are you? I'm not poo-pooing active. I'm just saying it's not for me. And a lot of my investors do a little bit of both. And so knowing what kind of investor you are, and if you don't want to be actively managing, do know though that there is an active component to due diligence. There's an active component to knowing what you're going to invest in as a passive investor. So really knowing yourself comes first, knowing where you are on that risk spectrum as well. Then when you're looking at diversifying a passive income portfolio, you're going to be looking at preferred asset types. So in the universe of real estate, obviously we have multifamily, there's senior that I talked about before, there's commercial, there's triple net lease, there's retail, there's hotel, there's self-storage, there's mobile home communities. I mean, there is so much out there. So there's these asset types, and even within real estate, knowing what the asset types are that that are most interesting to you, the thesis around those that make the most sense to you personally. Not everything resonates with everyone, and that's okay. Then when you start, and this was really my experience, like after real estate, all of these other worlds really started to open up, a lot of them around private equity. So when you start, you might say, okay, I have my foundation of real estate. So for me, that's about 70% of my portfolio. And then I can say, okay, well, what else am I interested in? Because there's a lot out there. There's oil and gas. You can get passive income from direct oil and gas. There's mineral rights. There's farmland, which is technically another form of real estate. There's private credit. I mean, you can still go in and you can still do, like hard money lending. You can invest in these funds. Those do pay out passive income. And then, of course, there's private equity, and then there's business income. You can invest in a franchise. I know right now, car washes are like all the rage. Everybody wants to invest in car washes and private equity. Or like, you can invest in other medical practices. You can invest in dental. So there's like this whole world out there. You can invest in other people's businesses. So you can add all of this to your portfolio. Those are all options that are out there. So as we look at all of that, we also want to look, and when we're building this portfolio and we're diversifying passive income, the duration. So how many years is this investment going to pay income? Is it a 5-year syndication? Is it a 2-year like high velocity kind of flip? What is it? Is it a 10-year hold? Is it a 1-year hard money loan? So when you build out that portfolio, you want to see like how long are my cash flows going to be coming in for, and you really want to like visualize that out. And so that comes into the laddering. So you want to be building, going back to your monthly or your annual passive income goal, you want to be laddering that in. You want to ladder in what's coming monthly, what's coming quarterly, what's coming annually, and then you want to ladder in the duration. So if something is exiting in 2 years, you want to just keep building it up. We used to do this with bonds, or they're called GICs in Canada, but like certificates of deposit, where you want to have certain things maturing on a rolling basis. So when I say laddering, I'm talking about things coming due on a rolling basis. So building that into your portfolio. And really, really important is building in resiliency. So not everything will pay distributions on time every time. And so building in that redundancy and the resiliency in your portfolio so that if you're counting on those passive income monthly goals, let's say, you're going to hit them. Or at least when something doesn't come through for whatever reason, it's not going to throw your whole life plan out of whack. So then there's other considerations, and I put this in other, even though it might be one of the primary ones, is going to be like, what's the rate of return? And what's the risk-adjusted rate of return? So when you have your goals, you also have to understand what rate of return do you need to hit that goal. So this becomes really important. So the geography, when we talk about diversification, are you diversifying by geography, especially with real estate? This is very possible. With operators, with syndicators, so you can diversify your partners, your investment partners. Nobody expects that you're only ever investing with just one firm. So you can diversify that way. You can diversify by type of income. So is it a preferred return? Is it business income? Is it rents? Is it simple interest? So again, so many different ways of diversifying. And then of course, looking at the tax implications. So this becomes a really big deal when we start to have a really big portfolio. You really start to look at the tax consequences, and those play a bigger role in the investment choices that you make. So a lot to think about. So this is how I map it out for myself. In part, I built myself a little spreadsheet where I can track it all. And this is a multi-tab spreadsheet. I wasn't going to share all of it, but like just I try to map out and see also, am I hitting my goals? Is what's coming in? Is it missing? When is it coming? And then when I started doing this, what I also realized was when I hit my goals on the real estate side and some other things, I really discovered I I love investing in businesses. I love investing in female-founded businesses, so venture. So I'm gonna have things across here for years with no passive income, but it's inside of my asset allocation. Like it's inside of a portfolio that makes sense to me. So also where my passive income can support my venture investing. All right, so I have some bonus tips from my experience. Give it time. It takes a long time to stabilize a cash flowing portfolio. Sometimes, there's certain things that, so for example, and I know that this is something a few people that I know, they do the carbon capture. And it takes 6 months before you start getting the returns. So you have to model that in. With alpha, for example, like it'll take sometimes even up to 6 months before you get that first distribution because of the stabilization that it takes. Don't over diversify, right? You know what you like, get comfortable with it, and focus on one thing at a time. I know, and for me especially, like I wanted to invest in everything all the time. And then I found I had like all these K1s and I was like, what did I just do to my life? And so you just and my accounting bill. So like really like find that focus. And this is part of the exploration and have fun with it. Like I'm good to laugh at myself and talk like this because it's a learning experience, right? It's a learning experience. But getting that focus and learning a category and really understanding it allows you to make faster decisions over time. Set up a tracking system, like I said, be a nerd. I always thought of myself a little bit as like the antichrist of Excel, but I'm actually pretty good at it. And I like it. It's very grounding when you're so heady and you're so up all in here and like all these different things going on, like land it all in your spreadsheet. It's really worth it. Hire a rock star accountant or CPA firm, definitely helpful. A business manager, potentially, just somebody that can help walk you through your ideas, especially when it comes to the tax consequences. When you're diversifying your portfolio, when you're diversifying passive income, somebody who really knows the ropes is indispensable. And remember why you're doing this. So go back to your goals. Go back to the spreadsheet. In my spreadsheet, the first tab is my goals. And then I track back to my goals. And check in with yourself. Like, things change. And so having that flexibility also in your goals and what you need today versus what you might have thought you needed even 6 months ago. Right, with interest rate changes right now, there's a lot of things that maybe we were all expecting some exits from certain investments that aren't coming because it's not a good time to sell. And so you have to go back to your goals and you have to go check and you have to go see. So that's really important. So check in with where you are, like quarterly, semi-annually, and enjoy the life that you're building. I think a lot of us, like, we want passive income not because like we want a life that gives us more time and more space to do the things that we love, and never forget that when you're building it out. Like really never, like really it's so important to come back to that all the time. Okay, so I'm gonna tell you just in the last few minutes a little bit about alpha investing. This is really, I was working there, but really where I learned the value of the real estate component, of the equity real estate component in different asset types. So, we're a private equity firm. We do a lot of needs-based housing, senior, affordable, multifamily, et cetera. We've done about 59 transactions in 20 states, and you can see all our statistics up here. One thing that is really important to know, and we talked about this on the last panel too, when we look at the IRR, is that's a high IRR, and that was the lowest we could get it, just based on like the different ways that we were modeling it out. Because over the last few years, everyone probably has had like really great exits, right? 100, 150 IRR exits. Those are not exits that any of us should continue to expect. And I say that like very transparently. So, when you're looking at the IRRs, like really understanding what does that mean? Because like an average IRR for us is probably more like 25 instead of the 31 or the 40s that when you do it on a weighted average, it looks more like 40. But so this is what I do for a living with Alpha. This is the basis of how I learned to underwrite real estate, how I learned to understand passive investing. And I do believe in real estate as the basis for a passive income portfolio. So this is me. If you want to get a hold of me, I'm always happy to speak to anyone. And I have a few minutes left, so if anybody wants to ask any questions. Oh, they turned it off. I didn't do it.
Can we have people, will you be around after this?
I am.
Find you after this in the break?
Absolutely, yeah.
Awesome.
Okay.
All right, well, thank you so much for your
Yeah,
talk. It was amazing.
Thank you.